In our today's video, we are looking at the reasons why you should consider investing in the two infrastructure bonds, that is the IFB 1 2022-14 and IFB 1 2023-17, as a way of creating a bond ladder that will guarantee you a near quarterly fixed income for the next about 11 years or 15 years respectively for the two bonds. But there is an option for a shorter investment period of 5 or so years and 8 years respectively, depending on the amount that you are investing or top-ups that you are making to that investment, and as per the terms and conditions of this auction. There are several questions that we are going also to answer through this video that we have collected through the comment sections of the two videos that we have done previously. And as we always say, our comment section is our suggestion box. That is the point where we will come back and look at the questions that you have and also maybe things that you are pointing towards that you need us to create videos over. And we have seen one question that started with the Tushi K on what effects it amounts when you top up your investment in either of these bonds, having invested previously in the same bonds, and you intend or you are looking forward to the medium-term investment period of 5 years for the FB1 2022-14 and IFB1 2023-17, giving you about 8 years of a medium-term investment, which is capped at 1 million of investment. We shall be answering that question and other several questions that we have collected from the comment sections after 3 seconds short break. So welcome to our today's video. My name is O'Brien. See you after 3 seconds short break. Welcome back. And the first thing that we are going to look at is the bond ladder resulting from you investing in these two infrastructure bonds. A bond ladder, which in many cases is also called bond layering, and in some rare cases it would also be called bond stratas, is purchasing or investing in two or more bonds with different maturity periods and paying coupons in different months. And the resultant structure is that these coupons will be spread out throughout the year, giving you a fixed income on the specific months that these bonds will be paying out. And that means that if you are able to assemble a minimum of 6 bonds, paying their coupons in the different months, which is spread out to cover the months in a year, that is January to December, then you will have staggered your investment in such a way that each month you will be getting a specified amount of income. These two bonds that have been issued are paying out their coupons in the month of March and September for the IFB1 2023-17, and the months of May and November for the IFB1 2022-14. That means that if you invest in these two bonds, you are going to get an income in the month of March, you get another income in the month of May, then the other amount will come in September, and the last one will be coming in November. If you put down those months and spread out the way they appear, you'll averagely get an income in every quarter of the year. Take an example of a person who is investing 1 million shillings in each of the two bonds. These bonds, we will treat them as the same because they are actually almost the same, because the coupon of 14.3% in the IFB1 2022-14 and the coupon rate of 13.9% in the IFB1 2023-17, if you take an average of the two bonds, you are getting a figure of 14.1 or so percent. And therefore, we shall assume that rate of 14%, which means that A million will give you a total yearly coupon of 140,000 as net. Net because infrastructure bonds are issued free of tax. So we are not deducting any amount from that coupon. The 140,000 will be split into two equal parts because bonds are structured to pay their coupons 2 times in a year. And those times that these bonds pay out their coupons are specifically and expressly given in the bond prospectus. And as earlier we have indicated, the IFB 1 2022-14 is paying its coupons in the month of May and November. And the IFB 1 2023-17 is paying its coupons in the month of March and September. And then that will mean dividing the 140,000 total coupon in a year into two, we will get an equal coupon amount of 70,000 each of the 4 paying months. You get 70,000 in March, you get 70,000 in May, another 70,000 in September, and 70,000 in November. If you carefully look at the spread in those months tally into specific months that we incur certain expenses, and especially for education purpose. You can attach any objective to the pay pattern of the investment that you are making. And that's why we always say that any investment that you are doing must be matched to a goal. That is the resultant structure. And our example of investing a million shillings in either of the bond is not a fixed, it's just an example. You could be investing 2 million shillings in either of the bonds, or you're investing 500, a total of 1 million, meaning 500,000 in each of the two bonds, which will give you a payout of 35,000 in each of the payout of the 4 months that we have spread out. And that will be your ladder. The next obvious question that we have identified, but very critical, is the question on the duration of investment. There are investors who are not interested in very long-term or long maturities in their investment. They want to invest in infrastructure bonds because, unlike fixed coupon bonds that give a fixed maturity period, and in any option that you want to invest for a shorter period of time, then it means you have to set that time to redeem or liquidate your investment through selling it in the secondary market. But infrastructure bonds give us an option of a medium-term investment period and the maximum horizon. In this case, we have a 5-year investment period for the IFB 1 2022-14 and an 8-year horizon for the IFB 1 2023-17. In that case, you have a condition that for you to get a liquidation or a redemption of your investment in those 2 short investment periods, you must invest not more than $1 million in either of the 2 bonds. Then the question is, what happens to an investor who wants to invest this time round, having invested a specified amount previously in the same bonds? And a good example has been given of a person who invested 600,000 in one of the bonds and now wants to invest an additional 500,000. Or a person who had invested $1 million shillings, the maximum in the previous auction, and now wants to invest another $1 million shillings in the same bond. And the question is, will the second investment be combined with the first investment and then throw this person into the longer maturity period when they want to remain in the short-term, medium-term investment period of 5 or 8 years? So do these top-ups or additional investments get combined with the previous investments, or they are treated separately for purposes of amortization? And this is the basis for the answer. The infrastructure bonds that are issued in a reopening auction, they are the same bonds that were originally been reissued. If you read the prospectus, these bonds are specifically provided that they shall be reopened in future, or there is a possibility of reopening for more investments to the same bonds in the future. This is more or less of what you can compare with a tap sale, which is an extension of bidding. But in this case, it's not a bidding. This is a reopening. The AFB1, the numeral value that is given as an extension to the name of the bond, that is only to tell that this is a reopened bond. And therefore, investing in a reopened bond, you are investing in the older bond that you invested in. The terms and conditions are the same. Therefore, if you do an additional investment that pushes your total investment above $1 million, you will have in effect pushed yourself to the higher maturity or the maximum horizon, meaning that on the specified amortization dates, that is in 2030 for the IFB1 2022-14, you shall be paid back a 50% of the total amount that you will have invested in that account. In 2033, you will be paid back a 50% of what you will have invested in the IFB1 2023-17, because that is the time for the first amortization. And therefore, to be specific, is that any additional investment that you make in these infrastructure bonds, additional purchase, that is a top up to what you had invested earlier on. In your Dow CSD account, the portfolio page, what will change is not the portfolio side. The number of bonds that you'll be holding will not increase by virtue of you investing in a bond that you had invested earlier on. But on the valuation part, the total value of your investment is what will increase. So if you had invested 500,000 in IFB1 2022-14, and right now you want to do an additional 500,000, on the portfolio side, the number of bonds that you are holding will not change because this is a bond in your portfolio. But the total amount is what is going to increase. The other question that is being asked is to put the word coupon in a simpler term. Coupon is a technical word in a bond in investments that refers to the interest that you are paid as a return for the government using your money. Because interest, by general definition, is what is paid in return for using other people's money. So coupon is just interest. It's a technical term that we use in bond investments, but it simply refers to interest. The other question that came with that simplification of coupon was on what happens when you default in payment of your successful bids. It is expressly stated in the terms and conditions of the issuance of a bond that in the event you don't pay for bids that you invested or bids that have come out successfully, then you'll be treated to be in default, and you may, the word is may, there is a probability that you may be suspended from future auctions. Out of experience, I haven't seen it happen anytime, but you should not make it a habit of bidding for bonds and not paying once they turn out successful. You don't know what may happen in future. You could be the first person to be suspended from future auctions. Another question is, how do we access the Dow CSD account? To create your account, what you need to do is either visit the CBK website and create your account from the website, the portal, or download the Dow CSD app from your App Store or Play Store. Then once you have downloaded that application, then with you have your email, you have your mobile number, and you have your other KYC documentation. You need your KRA PIN, you are going to need your ID, and you need a passport size photo. And nowadays, a selfie will be enough for you to create your account. Then once you uploaded all those information, then you wait for the approval that takes not more than 3 days at most, unless there is something very important that you did not include, but you will also be prompted to make corrections where you go wrong. And once your account has been approved, you'll be free to place your bid. We have up to 12th February 2025 to create your account and place your bid. In addition, we have several videos in the channel that touch on the creation of your DAO ZSD account, how to place a bid, how to pay for a bid, and many other videos touching on analysis of various bonds that have been issued. You can go through the channel, study those videos, and you'll have a lot of value information that will help you in future investment in bonds. The other question was on whether it's possible to calculate the coupons or interests payable out of your investment in bonds, having your coupons there, you know, the face value and all that. And yes, you should be able to determine all those figures because the coupon is already given. You know what you want to invest. And with that, you have all what you need to calculate your specified amounts, because if the bond is a fixed coupon bond, then it will also be indicated the rate of tax which will apply depending on its maturity period. But in general, fixed coupon bonds that are of 10 or more years to maturity, they are taxed at 10%. Those of a lower maturity period, they will be taxed just like money market funds at 15%, but infrastructure bonds are issued tax-free. So in our example of the infrastructure bonds at 14%, if you're investing 100,000, because in our case, the minimum amount that you require to invest in bonds is 50,000. So if we take an example of an individual who wants to invest 100,000 at a coupon rate of 14%, that will translate to 14,000. The 14,000 will be the gross and also the net coupon, because this bond does not attract any withholding tax. And that means then on the specified coupon payment month, this investor will be receiving 7,000 as the respective coupons. For if you are talking about the IFB1 2022-14, which is paying its coupons in May and November, then you will get 7,000 in May and another 7,000 in November. The last question was, with the second infrastructure bond, that is IFB1 2023-17, that is paying its coupons in March and September, and this auction happening on 12th of February, the question is whether the investor will be paid the coupon that will be paid in March. And the answer is yes. All investors in this bond that is going to be paying its coupon in March will be paid that coupon, because on the auction there is an element that we call accrued interest. And accrued interest is the coupon that has been earned by those who have invested in this bond from the last coupon payment date, which was last September. Interest has been accruing up to the value date, which is 17th of February. And this is the accrued interest that will be added to the clean auction price to determine the dirty price that we are going to be paying for this particular bond. So by investing in the bond, you have already purchased the accrued interest. So once you buy the bond in March, you will be paid the full coupon for that period. Lastly, but not the least, if you had invested previously in one of these bonds and you want to do a top-up that is likely to push your investment above $1 million, and your intention is to enjoy the shorter repayment period of either the 5 or the 8 years, the only option that you have is now to invest in the second bond that you did not invest previously. But the bonds having a different medium-term investment period, maturity period, the one having 5 and this one having 8, then you have to, it should be acceptable to you to lengthen that maturity period, because obviously the two bonds are giving us different maturity periods, and also in the amortization, that difference will also be there. The first one is giving you a 5-year period. The second one is giving you a 8-year period. The difference in the coupon rate, 14.3 and 13.9, is meant to compensate for this short difference in their maturity period. And that's why in general we are saying that these two bonds are just the same. The only difference is in their coupon paying months. So thank you for watching, and see you in the next video.